Okay, I think there's still a few people joining, Sarah, but I think we'll get going.
I think go ahead there, Claire. Yeah, great.
Great. Okay, so good evening, everybody. My name is Claire Hanrahan, and you're very welcome this evening to our investment webinar. So I suppose, look, I just want to go through a few bits of housekeeping before I make introductions to the panelists that are going to walk us through the great information for you this evening. So I suppose, look, my name is Claire Hanrahan. I am the COO and a director here at Irish Pensions and Finance. We're delighted to be here this evening. This is our second year doing this online. We did it for many, many years in person, in town, and I suppose last year we put it online and it went really, really well. I suppose we had a decision this year, we go out and do it again in person, but I mean, we have people that are going to be logging in here this evening from up and down the country. We have people logging in from abroad. So we feel it's just a really good forum to allow clients and prospective clients to join and get some great information about investments. I suppose, look, it's going to be about 45 minutes long. We're going to have the chat function off for the majority of the actual presentation. I know a lot of the attendees have sent in questions. We've hundreds of questions that came in. Really, really good questions, very important. Having looked at the slide deck, I feel that we will cover a lot of the questions throughout the actual presentation itself. However, if we don't get to cover your own individual question, following this investment seminar, you can get in touch with your IPF financial planner who'll actually help you go through the questions. So that's the bit of housekeeping. Now, just to keep things interesting, we do have a little competition. So at the very end of the presentation, there will be a question about some piece of information that was given out during the seminar. And the person who gets the first answer right on the chat function, so we will open up the chat function for the question, will get a €100 voucher for either BT or Louis Copeland. So we want to see, we'll keep you on your toes, find out who's listening. And look, I said before I introduce you to the panelists, I want to say thanks very much. Sarah Connolly is our marketing manager and our producer, so she's put this together for us this evening. So is there anything I've missed there, Sarah, before I kick on?
I don't think so, Claire. No, it's just great to see so many people on, I suppose. I think we're in a new technology world, which is great that people have access now. So, and look, we'll make sure and follow up with everyone. We'll send an email around tomorrow with a recording of this. So just if anyone wants to go back on any of the slides or anything, we'll make sure and get that around to all the attendees tomorrow.
Brilliant. Okay. So I suppose, look, without further ado, we're really lucky to have the people we have here this evening. So I want to introduce you to Stephen Dixon. So Stephen is the head of broker development. Stephen works with New Ireland Assurance. So Stephen is going to talk to us about New Ireland's piece here in the evening. We've also been joined by James Forbes, and he is the head of investment solutions for Goodbody Asset Management. And Stephen and James were with us for this last year, really well received. And from my point of view, I think the guys will make things really understandable from a layman's point of view. So I think that's really, really good. And we've also been joined by Wendy Thompson. Wendy's one of our senior financial planners at IPF. She's one of our managers as well. So Wendy's going to talk to us about, from the client's point of view, what they should be thinking and doing. So that's the panel we have this evening. So, okay, I suppose when you're sitting there as a client, you're kind of trying to figure out who is everybody, IPF, New Ireland, Goodbody, where does it all fit in? So I suppose we've done this slide up. Irish Pensions and Finance, and I'm going to give you a little bit more background about us here in a minute. We're your broker, okay? So we're the ones that sit down with you and find out what you need. If you make the decision to do some business, then we can hand over that business to New Ireland Assurance, who will package it up. And I think, Stephen, you'll probably explain it in a little bit more detail in a few minutes. And then the money can be invested by Goodbody, which is what James will discuss. So they're the three pieces of the puzzle. I suppose just to give you a background on Irish Pensions and Finance. So we were established in 1993. We have 24,000 policyholders with over 30,000 policies. So we're really proud of that number. And another number that we're really proud of is that we've 3,800 of our clients have actually retired. So that's a journey that we're always really excited to help them out with. We've over 680 million in funds under management. we're an authorized advisor. So once again, what does that mean? It basically means that we don't work for any one institution. We work for our clients. So, you know, we don't work for any one bank. And we're an independent brokers. We have a team of dedicated financial advisors. And as well as that, we've got a really good back office team. So, you know, everybody at IPF are have exams or sitting exams, etc. So, we really want to make sure we put our clients front and center and look after you. Okay. Okay, Wendy, I'm going to bring you in for this slide.
Okay, yeah.
So I suppose, look, everybody came here this evening and logged on for a certain reason. So I suppose there's a few questions. I had a question in from Pat in Galway, and he was just asking about deposit rates, and you know, he was worried about inflation. So why should people think about investing?
I suppose there's a number of factors, Claire. Obviously, these are outlined here on the slide: deposit rates, inflation, cost of living increasing, and making your money work for you. And I suppose we're seeing more and more of this in the media. I know there's been a lot of write-ups recently just about inflation in general, which James and Stephen will cover later. But I suppose inflation is a huge thing. I suppose to describe what inflation is a general increase in prices, but the fall of our purchasing value. So I suppose it's holding the value or spending power of our money. Now, I suppose the problem that a lot of us are faced with is that we're not getting return on our deposits at the moment in the bank. So James will elaborate on this in more detail, how deposit rates are affecting people that are holding money in the bank at the moment. And a matter of fact is it's negatively impacting a lot of us. And how we can see this is, well, I know I was giving out anyway about my gas bill that came in a few months ago. I'm sure we've all seen the prices rise in utility bills between
filling up the car.
Filling up the car is a big thing. You know, and this is really important to make sure that our money's working for us. So, you know, we're getting more informed about what's going on. And this is the purpose of tonight is for people to get thinking about these things and making their money working for them. And I suppose it's really important that you get informed about these things and make sure that you've got the right plan in place to meet your goals and objectives.
Great. So I know what we're going to do is, I suppose I had a question from John and Leash. So he was just saying, look, if I want to invest money, like what normally happens? So I suppose, what does this slide mean to John, Wendy?
Well, I suppose, Claire, look, in my view, it all starts with the consultation. Okay. I suppose from my point of view, in order for me to do a good consultation and offer, I suppose, the best advice to my clients, there needs to be a few things in place to have a successful appointment. And I think, you know, our clients need to be aware of these things. My objective, and any advisor's objective, is to put the best possible plan in place to meet, you know, the individual's objectives and their goals. But I suppose in order for me to do that, it's really important that the clients engage in this process. Okay. So there's you know, we have to build trust with our clients. And I know for me, it's not something that happens easily. I have to earn the trust of my clients. And for me to do that, I suppose I put my clients' interests at the forefront of any recommendation. I'm clear and transparent about the things I have to do. And we'll discuss this later in the presentation, but that's especially around the likes of charges, the level of risk, which again, James and Stephen will elaborate on, and particularly the funds then that the guys will touch on as well. But most importantly, you have to be able to trust your advisor. And again, the advisor follow through on the time frame that they give you in terms of, you know, coming back to you on these things. So it really starts at the fact-finding process. For me, it's really important that the clients are really upfront with me about, you know, their assets, their savings, what they're currently doing. Because if they're not, I'm not really giving the best advice because I don't know the full picture. It's like going into the doctor and asking for medication.
Okay.
And not
so it's good for the client to have all their, you know, as best they can, their information prepared before the fact find.
Exactly. And I'll talk about that a bit later about what the clients need to prepare for the call. Right. But I suppose at that point, once, you know, we've established what the client is looking for, and we've built the trust, we're really in a good position then to identify the next part there, the goals and objectives. So I don't know if anybody, I'm sure there's a few, I know I've been speaking to some of my clients this week, which mentioned the retirement seminar that we had there recently. And the last time on the presentation, the MD spoke about 3 pots. It was an analogy that we discussed about your short, medium, and long-term goals. Okay,
Oh, yeah.
These are the 3 pots. But in each of these pots, there's 3 different, completely different ways that we invest. Okay, so that's something that we discuss with you in our consultation process about what your short, medium, and long-term goals are.
Great.
Now, Stephen and James then will actually tie up the next part, the risk assessment, because each individual is going to be different. You might talk to even your husband or your wife, you might have completely different levels of risk. Some might want to take more risk, some might want to take less. So normally what we do there is we get you to fill out a risk questionnaire, and that helps us then establish what level of risk you might be comfortable with, which then in turn obviously helps us build a recommendation for you. But yeah, I suppose a thing to consider there, Claire, is really, your short term is really anything that you're planning on doing with your monies within the next 5 years. Normally,
you need access to that.
Exactly, yeah. And then from 5 to 10, we would say would normally be the medium term. And then thereafter is your longer term. But again, like these can spill into each other. You might get good returns on your medium term investment, which will spill into your longer term. But I suppose it's different for everyone. Now, I suppose where the consultation really comes into play is you might have a high amount of short-term needs, for example. Okay? And therefore, our advice might be the fact that, look, Claire, don't do investments. There isn't much leeway there. So again, it's not always to, take out an investment. We'll be looking at what is going to put you in the best financial position. And that's where we really have to engage in what's important to you, what you need access to. And you need to be thinking about these things coming up to the meeting.
Brilliant.
I suppose another thing where we might say maybe, not to do an investment is, again, if, let's say, for example, I've had clients where they'd say, look, I want to take a really high risk, but I want to take it back out in 2 years.
Okay.
That's where, we have to have a conversation with you. We have to show the risks of these involved. Again,
and I think the Stephen and James are going to talk to us about the timing and stuff like that. So
exactly, yeah. But again, like it's important that you're making the best financial decision for yourself. Now, I suppose that's when we come back with the recommendation. And once you're happy with the recommendation, this is where the application process comes into place. So there's a few things that we do in the application. One is that the application, which is quite straightforward. There's an application you have to fill in, but there is other documentation that you get in Ireland when it comes to investments. And one is your statement of suitability. So I was saying to you earlier about the transparency and knowing about the charges and the investments in the funds. This really solidifies why the recommendation has been made to you.
Okay.
And it also outlines the charges, the funds, how you can take it out. Okay. So again, I suppose it's your protection as a client, and it really solidifies the reasons why you might be taking out an investment.
Perfect.
And then I suppose we always advise that you keep those on file for yourself, because this is what we refer back to then in the last section there, the regular reviews.
Yeah.
So it's very important that you review your policies because your objectives will change. And it's very important that you review these because we can make the adjustments accordingly then to suit your needs.
Great. And I think it's great. I suppose, look, we're going to hand over to James and Stephen now in a second. And then we'll loop back to you at the end, Wendy, just to kind of, so I suppose at this stage, we don't know, should people be investing? And I think what's great actually is I saw the list of attendees. There's a lot of people here that are existing clients. So they would have joined last year at this, and and I think, look, from the client's point of view, for James and Stephen, like these guys would normally only deal with brokers pretty much. They don't normally deal with the end user. So I think it's great, and I always find it really interesting to hear what you have to say about what's going on in the world of investment. So I'll hand it over to you, Stephen and James, and take it from here.
Hello, thanks a million, Claire. Thanks, Wendy. It's hard to believe it was a year that we did the last presentation. It's flown by, but an awful lot of things have happened in that year, and we'll get stuck into them. Just to explain where New Ireland sit in the process. So in New Ireland Assurance, we basically administer the investment. We'll issue the policy documentation, we'll take in the money, and we'll make sure that it's governed and that it's taken to the investment manager. But we don't actually invest the money directly ourselves. We have got the luxury of going into the market and being able to bring the best possible fund managers available in the market to you and to the Irish Pension and Finance clients. And on that note, I have with me today James Forbes, and James is the head of investment solutions in Goodbody Asset Management. Goodbody have a few funds, 3 or 4 funds with New Ireland, all of them performed exceptionally well. And I know there's people on the call here today that are invested in the Goodbody dividend income fund. I know there's a lot of people invested in that, and it's done particularly well. So just to introduce James. Hello, James, and thanks a million for joining us today. It's great to hear from the horse's mouth, so to speak, the investment manager themselves.
Good evening, Stephen, and good evening, everyone. I'm delighted to have been asked back again, and hopefully we can provide a bit of an update on where things currently are standing.
Brilliant. Thanks, Bill. So look, we're going to look at four topics this evening. We're going to look at the first topic is just why to invest. So why would you invest? So just looking at you know, the various pros and cons of investing, I suppose, and the threats that if you don't invest, or the threats that you do invest. So we'll just have a look at that. We'll have a look at the investment options, kind of looking under the bonnet of investments and what they're made up of. We'll look at some possible solutions. That there are funds available in the market, and you know, who they suit and why they suit particular people. And then, as Wendy pointed out, then we look at the next steps. And I think, you know, throughout this presentation, we'll keep referring back to getting advice. It's very important that you sit down, that you do go through that process, and that you have a robust conversation with an expert advisor in Irish Pension and Finance to get, you know, the best possible outcome for you and your money. So James, it was I think said we presented it was nearly a year ago today. Actually, we presented, and at the time, you know, COVID was rife, and COVID had really affected investment markets. But although it affected markets quite badly, markets priced it in and kind of rebounded and came back, and we were able to sort of say at the time that markets had actually come back. Now, since then, we could never have known that there was going to be a war breaking out in Ukraine. And just to say that our thoughts are with the people of Ukraine. It's a very, very difficult time for the people of Ukraine at the moment. And we will be referring to Ukraine. Obviously, today we're talking about investments, and we do need to talk about the Ukraine, because geopolitical incidents like that, they do affect investment markets. Like, they do have an impact. And I know you're going to just maybe touch on that slightly. Inflation, when you touched on it, every time I turn on the radio, it's about inflation. You keep hearing about this. We spoke about it a year ago. I think when we spoke about it a year ago, we were talking about 1% and 2% and 3% inflation. I think now, you know, those figures are a lot higher. And then the last point, I suppose, is interest rates. There's talk of interest rate increases. And, you know, are they good or are they bad for clients? So just from your own perspective, I know in Goodbody you do a lot of research in this space. Could you maybe share with us some of the findings that you have, and you know, why these things have been good or bad for markets, and I suppose specifically how the Ukraine has affected the investment horizon?
Yeah, Stephen, I think you've hit the nail there on the head in terms of some of the major topics that are certainly impacting markets, and it is hard to believe it's 12 months since we last done this presentation, and since then, you know, if you had been invested in markets, you probably have done quite well. You know, equity markets over that period are up about 15% over the last 12 months. Indeed, in 2021 alone, global equity markets, and I appreciate not many people are totally invested just in equities, but global equity markets last year were up over 30%. So it was a very strong year for equity investors. And I think, you know, as I was reading a lot of year-end outlooks by the major investment banks, you know, the Goldman Sachs and the Morgan Stanleys of this world back in December, and they were talking about all the potential issues that the market might have to overcome in 2022. The one that no one really picked up on was the one on the very left-hand side of this slide, which is Ukraine. And I suppose as we sit here tonight, Stephen, you're dead right. You know, we're sitting looking out on a fine evening in Ireland, and blue skies, and the sun is shining. And it's hard to believe we're in one part of Europe and there's something very terrible happening in another part of Europe. And that certainly is having an impact on markets. It's having an impact on supply chains. It's having an impact on consumer confidence. But I was doing a presentation actually earlier on today, and I was asked by a client in that presentation, since the invasion of Ukraine, how far down have markets fallen? And actually, since the invasion of Ukraine, markets have actually rallied. They're actually up around about 5% since the invasion of Ukraine back on the 24th of February. So what it does illustrate is while Ukraine is a factor in investing at the moment, the other factors, and this is largely driven by a lot of the US investors, they're much more concerned about what's likely to happen to inflation, and if inflation is likely to drive what central banks are going to do. So while Ukraine is certainly there as a factor, the driving factor behind what's happening in equity markets and investment markets at the moment is the center there, which is the inflation, and then obviously what the Fed might do. And I suppose, we're talking about the Federal Reserve in the States, and a lot of the focus is there, but it's not just in the States, because the European Central Bank has also been watching these inflation figures very carefully, and they're likely to start to move. And that will have an impact on many people that are listening in tonight to the conference, because when you look back, one of the options for investments over the years might be to go and put your money in a bank account. And certainly, if you went back over 12 years ago and you had some money to invest, you could walk into the bank and you could get well over 5% per annum return on your investment. Even in 2014, you'd have got 2% per annum. But if you look at the returns you're likely to get today in the Irish market from any of the banks, and of course there's two of the major banks are pulling out, the return that you'll likely get today is 0.15 of 1%. So you're getting virtually 0% on your return on any deposits that you might have in the bank today. And of course, the reason why the Irish banks aren't giving us as depositors any returns is because what's happening with regards central bank and the European Central Bank. And this next chart, Stephen, just looks at what the European Central Bank interest rate has been doing over the last 15 or 16 years or so. But really what you can see is that since 2012, we have actually had a decade of either zero or negative interest rates. And that has been incredibly uncommon throughout the decades. We've never seen something like that before. So it's a very unique position whereby we're in today, and we're seeing negative interest rates being charged by banks between one another. And if the banks themselves aren't being able to charge, then they're passing that on to customers, and they're saying, we're not going to pay for your deposits. Now, the one thing I would say, though, is that things are changing, and they're probably changing quite quickly, because what we do expect to see is that the negative interest rate today of minus 0.5 is likely to move positive before the end of this year. So we expect the European Central Bank to increase interest rates for the first time in over a decade back in July of this year. We expect that they're going to move again in October, and they'll move for a third time in December. So by the end of this year, the European Central Bank rate will be marginally positive. So that's quite a change for investors.
Just on that, James, we actually had a question in from, it's Anne here in Cork, and the question is, if interest rates are going back up, because obviously we've heard a lot of talk about this in the news, and interest rates are going to back up, is that going to be good for investors then? Because they can obviously put their money in the bank again and get a good return from the bank. And B, will that be negative, I suppose, for mortgage interest rates and repayment of mortgages and variable rates on the mortgage side?
Yes, Stephen, that's a very good question, and in fact, there's two very different answers to that. So the first part of your question there was that if the European Central Bank is increasing interest rates, will the Irish banks pass that on to us as depositors in the banks? And what we're seeing is that the European Central Bank rate is only likely to get to 1% by the end of 2024. So we don't think that there's going to be a massive increase in the European Central Bank rate. And we don't think that the Irish banks are going to pass that on to depositors here, because the Irish banks, the Bank of Ireland, AIB, are very strong. They don't need any more deposits in, so they don't want to attract any more. So they're not likely to actually increase their deposit rates. But the other side of it is On the mortgage side, yes, they'll pass those increases on straight away, no doubt about it. And, what we're already seeing, even in the fixed mortgages rates over the last couple of months, those fixed rates have been nudging up. So yes, the mortgage rates will go up, but deposit rates are likely to stay very close to zero for the next few years. So I suppose, that's a little bit about, what's happening in rates, and, the rates are starting to move. And certainly in the US, interest rates, we had an increase last month. We're expecting 8 more increases in the US interest rates this year. So they're moving a lot quicker in the US. Europe is a lot slower. But why are they increasing interest rates? Well, they're really increasing interest rates because of what's been happening with regards to inflation. And there's no doubt about it, we're going to see inflation creep through. And inflation is often called the silent thief. And I was doing some work for a client last week, and we were looking at some prices historically. And one of them was with regards, what's happening to the consumer and outspending money. And I was looking back to see coffee prices. And I got this from an article actually in the Irish Times, when there was a letter into the Irish Times given out about the price of a cup of coffee on Bewley's in Grafton Street back in 2002. It cost a whole €2.40. So what I did, I went and looked at the Bewley's website last week as well to see what the current price of a cup of cappuccino is. And the price today has actually risen by up to $4.40. So we've seen quite an increase there in the price of a cup of coffee over 20 years. But the key thing I want to get across, though, is that we've seen very modest general inflation over the last 20 years. In fact, we've almost been in a deflationary environment. Food prices have remained very low. A lot of commodity prices have remained quite low. We're getting a lot more value for our money. The supply chains are good. So in that environment over the last 20 years, you have to expect that inflation generally is incredibly low. Yet the price of a cup of coffee has risen over that period by about 3% per annum. So if you're thinking as a consumer or an investor going forward, and you're saving maybe for your retirement, you need to think of a lot of goods are likely to increase, particularly over the next few years, by at least 3% per annum. So if you've got some money, you've got to try and make that work for you to cover the cost of inflation, and that's very important. And I suppose, we've maybe shown these sorts of slides before, Stephen, whereby, we've looked at the threat of inflation on your savings. And I think last year, when we were looking at it, we were looking at different assumptions of inflation and, maybe a 1% or a 2% or 3%. But there's no doubt about it today, we're looking out over the next, 10 years, potential inflation rates are going to be significantly higher than what they have been. So if you had 50,000 in your savings today, and you put it away and you weren't getting any return on it from your bank, the real return on that 50,000 after 10 years would mean that it's only worth 37,000. So you've actually lost money. Your purchasing power has gone down. You've still got your 50,000 in theory, but the cost of all the goods that you might want to buy has gone up. So the real value of your money has gone down to 37,000. If you then assume that inflation was going to be slightly higher, let's say 5%, then the value of that 50,000 in 10 years' time would have fallen to just 30,000. And if you assumed inflation at 7%, then the value of your 50,000 pot would be down at about 24,000. So this is the silent thief. It's eating away at our savings every night, and we've got to do something to try and protect ourselves against inflation. And I think it's worth putting in context here at this point is that the latest reading that we got for inflation in the Eurozone, which was the March reading, showed that prices rose year on year up 7.5%. Massive increase. It's not something that we've seen over the last 25 years. And what's been driving that? Well, as Claire was saying earlier on at the very beginning, there's no doubt about it. We've seen lots of increases in commodity prices. As we go to fill up our cars with petrol or diesel, seeing the price of oil going up quite significantly. But I suppose the one that's really hit home is the price of gas. And, that's for obvious reasons that Russia controls a lot of the gas market in Europe. There's supply issues there and what's happening. But it's not just in terms of some of the commodities that are industrially used. We're also looking at some of the soft commodities as well. So we're looking at things like wheat up 70-odd%, looking at coffee up 70% and sugar 22%. So if you're thinking of going into O'Brien's, tomorrow morning to grab your coffee and your croissant, those core products are going up in price, and most likely you're going to be paying a lot more for them in 3 months' time than what you're actually paying today. So there's no doubt as well in terms of, what's been happening, there's a number of factors in behind, what's causing these price increases. I suppose the first one was that the central banks had a very loose policy around for the last 4 or 5 years, and they printed a lot of money. So that created a lot more money chasing different assets. But there's also been a number of things like supply issues after the COVID crisis. There's been a lot of factories in Asia, have suffered and aren't working at full capacity. So there's been problems there. And of course, as we mentioned earlier on, the situation in Ukraine is having quite an impact. Ukraine's a major exporter of wheat into Europe. So, those exports have slowed down quite significantly. And the other area, just even closer to home, when you look at some of the farmers here, they need a lot of fertilizer, and Russia is one of the largest exporters of fertilizer. So we've got problems there in terms of costs and getting hold of raw materials, and that's forcing the end prices of a lot of goods up to us as consumers. And that'll have an impact ultimately in terms of some of the companies that are quoted on the stock market as well. So maybe just moving on in terms of inflation expectations, and what we were looking at here is some expectations based on some German bond market pricing. But effectively what this is looking at what investors are thinking about inflation going forward. So the blue line is the expectation of where inflation will be for the next 10 years. And it's gone back, over the last 12 or 13 years. But I suppose what you can see, on this chart, if you look just beyond July 19, you can see the significant dip. And that was in the first quarter of 2020. Whenever we were right in the middle of the COVID crisis, and people were really worried because what we saw was the lockdowns, economic activity virtually just stopped overnight. People were worried that there was too much capacity, what was going to happen, demand might not come back fast enough. So the expectation for inflation fell very significantly. In fact, back then, investors were only expecting inflation at 0.5 of 1% for the next 10 years, each year. So very low. But if you look at what's happened since then, the expectation for inflation has risen very, very significantly. So we've gone from a low of 0.5 back in March 2020 to today, where we're close to 3%. And I think that's very important because, as investors today, there's no doubt about it, inflation is much higher than 3%. As I mentioned, it's running at about 7.5%. It will start to ease off later on this year, but certainly for the next few years, as investors, we need to probably pencil in that inflation will be running, above 3% for the next few years, and certainly into any models or financial planning that we're doing. I think that's the sort of figure that we should be considering, particularly when we're looking to make investments. So maybe at this stage, what I might do is maybe just hand over to you, Stephen, and maybe you might just talk us through some investment options that might be there and available to potential clients, to try and protect themselves somewhat from the threat of inflation.
Sure, absolutely. Yeah, no, thanks a million for that, James. Very interesting. I think just to summarize what you're saying, well, firstly, I think I'm going to start bringing a packed lunch with me to work, looking at some of those price increases. I won't be going into O'Brien's or into Bewley's. I'll be drinking instant coffee. The other thing is obviously that's the things that stand out. Banks, although interest rates might go up slightly, they're not going to be passing them on to customers, so we're not going to get any return for money that's on deposit. And I suppose the other point then that I take away from this is that obviously inflation, we're looking at probably over the next 10 years, it's here to stay, and we're looking at possibly an average of around 3%. So what does that mean? If you're an investor, or you do have money that maybe, as discussed earlier on, isn't short-term money. So we look before sort of having short, medium, and long-term money. Something in that medium to long-term space, you will have to look at something, an investment, if you want to beat that inflation, is to invest in what we call real assets. So assets that can actually get your money working for you and outperform that 3%, 3-4% inflation, so that you haven't got that silent thief sort of eroding away your money or your purchasing power. So in the market today, there's a lot of investment options. The most, I suppose, popular ones will be multi-asset funds, and they come in many sort of shapes and sizes. But most of them are made up of these types of asset classes. So just going to run very quickly through the asset classes. We looked at cash deposits, and really that's for your shorter term money. You will need to keep liquid cash on deposit. But within investment funds, you will also have some cash within the funds just to give some liquidity and to give some stability. And it's considered lower risk. The other would be government bonds. You'll see an awful lot of government bonds in these funds. A government bond is effectively where you lend money to a government. The government then pays you back a percentage per annum over a period of time. So at the moment, Ireland have a government bond that's 10 years, and they'll give you about 1% per annum over the 10 years. Corporate bond is very similar. It's just you're lending the money to a corporate, to a big company, and they will pay it back. Slightly more risk, obviously, of a company possibly going under rather than a government going under. But again, these are huge, big companies that you will be lending the money to, and they will give you then an income from that. So you get them within an asset class within these multi-asset funds. Property, big part of multi-asset funds. You can have them in different shapes and sizes, but a lot of them will be commercial property funds. So you might get sort of 20 to 50 commercial properties within a fund, giving you obviously rental income, etc., managed by the investment manager, but again, an asset within a possible multi-asset portfolio. Commodities, touched on it there. You've got things like gold, oil, copper, all those types of commodities within the fund as well. And then finally, equities. You've heard equities being referred to throughout the conversation, but equities are effectively a share in a company. So you're basically buying a piece of a company, and you could be buying, the big ones, Amazon, Facebook, Netflix, all these big companies. You will actually be buying a share in those. So all of these are all different asset classes. And it's just important that when you look at the asset classes, they do range from being, having lower risk, and higher, lower risk ones that will obviously, a lower risk, you would expect lower returns, and higher risk, you would expect higher returns. Doesn't always work out that way, but over time, that's how they play out. So as an investor, when you look at these assets, you kind of look and you say, well, how many government bonds should I have? What percentage should I have in government bonds? Or what percentage should I have in property or equities? And that's where getting advice is really, really important. Because as an investor, you're going to have different attitudes. Wendy touched on it earlier on. And what I suppose Irish Pension and Finance will do is they'll put together a fund for you. Well, the funds are put together, but they will actually put together your attitude to risk together with a fund. So you can see here, cash deposits, government bonds, corporate bonds, they'd be on the lower sort of risk spectrum. And then at the bottom, you've got property, commodities, and equities. They're more growth assets and will be considered slightly higher risk. But as it says at the bottom there, everybody's jigsaw is different. So how do I know when I'm talking to client A that their attitude to risk is different than client B? So Irish Pension and Finance have a tool. It's a risk assessment tool, really, really good piece of kit. It's 15 questions that's been put together by Oxford University. And when you answer the 15 questions, it will then give you a number and say, Stephen, you are a number. And most people we see coming out in that sort of area 3 and 4, that low to medium risk. And you can see on the right-hand side there, there's a scale where 1 is very low and 7 is very high, and you're able to take loads of risk, and you go 100% into equities, and you don't mind if your fund goes down one year and up the next and down the next. You're comfortable with that volatility. But again, as part of the process,
just from a client's point of view, like how long does it take to fill out that questionnaire? Is it online
again, they can contact. I would suggest they're contacting Irish Pension and Finance. Irish Pension and Finance can send them out a link. Simply click on the link. It'll take you less than 5 minutes to go through the questionnaire. When you've gone through the questionnaire, it actually will send that back into Irish Pension and Finance, and they can actually then assess it for you, and they can do. I know I've seen the reports that you produce are excellent, and if anybody takes anything away from this today, even if you want to just do this to see where your attitude is to risk, just contact Irish Pension and Finance, get that link sent on. It's a worthwhile exercise. I've done it myself, and it's a very, very good piece of kit. So I recommend that people ask one of the planners, Claire, to have a look at it and send out that link.
Great, thanks.
But again, really important to get advice in this space, because the beauty of this is that if you come out as a 3, that then means that you have a certain capacity for risk, and that capacity will suggest, because of the questionnaire, that you're able to take markets going up and down in a certain manner. And I know, James, you and Goodbody, you've put together specific funds that actually match up with this 3 and 4. And that 3 and 4, I don't know if you want to explain this little small bit about volatility, about the bands of volatility. I know 3 is sort of a band between 2 and 5, so it means that you're able to take a certain amount of risk, whereas 4, obviously, the risk is higher, but it would mean that the client has that capacity or propensity for slightly more risk within an investment. I know you have a couple of funds there that you're just going to touch on, your GDI 3 and 4.
That's right, Stephen, and you're right as well. I mean, when many people do this questionnaire, a large number, highest proportion, either come out as a 3 or a 4. And that's typically that's the area where most funds are sold in the marketplace. And as you mentioned earlier on, what the 3 fund does, it looks at the volatility and it measures volatility. And effectively what volatility is, how much is a fund likely to go up or down, more so on the downside. So you're trying to protect people. So if somebody's low to medium risk, you don't want them going down too much. If somebody's more medium risk, well, maybe they can afford to take a little bit more down because they know they'll get the up in the years ahead. So that's all that the volatility is actually measuring, is what's the likelihood and probability of returns going forward. And certainly within that space, yes, at Goodbody, we've created 2 funds, one in the Dividend 3 fund, which is in the category 3, and one in the 4 category, which is Goodbody Dividend Income 4. So, I mean, if you look at those funds as they stand today, this is the Goodbody Dividend Income 3. So this is the lower risk fund. And this is the mix of assets that's in this fund. And what you see in this fund is that, in terms of its exposure to companies or equities, it's got 40% exposed to dividend paying companies. What you'll also see in terms of its exposure to cash, it's actually quite high, 18% in cash. And that's to smooth the journey for a lot of investors that might want to be invested in this sort of fund. And its sister fund is called Goodbody Dividend Income 4. And it's exactly the same type of fund. It's exactly the same companies that we invest in. It's just the proportions are slightly different. So in Goodbody Dividend Income 4, what you'll see there is that we're invested in 70% in equities. And the equities that we invest in are dividend paying companies. So instead of 40% in the Goodbody Dividend Income 3 fund, you've got 70%. But that means you've got a lot less cash. So this fund will have a little bit more volatility, but what you would expect from this fund over time is that it will also produce a higher return. But the key thing between any of these sorts of multi-asset funds is that you need an engine of growth. And we always say that the engine of growth in any of these sorts of funds is really down to the equities or the dividend paying companies. And that's where we spend an awful lot of time trying to focus on finding, the best companies that are out there that have good dividends and can grow their dividends. And these are some of the companies that we have in the funds. And I suppose what you will see here is that you'll probably recognize a lot of the names, the likes of L'Oreal, Accenture, the services company, Johnson & Johnson, Motorola, Abbott Laboratories, and of course, Microsoft. And these are companies that have been around for a long time. These are companies that got very, very strong business models. And these are companies that got very high margins. And if you've got high margins, it means that you're likely to create high profits. High profits will create high cash flows. And if you've got good cash flows, then you can pay out strong dividends. But you're also likely to have good balance sheets as well. And that's very important because when markets get volatile, like they've been over the last week or two, the companies that are the strongest, they don't go down as much. It's the very weak companies that are very financially insecure. They're the ones that go down an awful lot. All these companies here are very profitable, good cash flow and good balance sheets. So they typically don't go down as much when markets get volatile. And that's very important to a lot of investors that go into these funds, because what we always want to do is try and smooth the journey and protect on the downside. And within the Goodbody Dividend Income Funds, we also have another overlay that risk manages some of the returns. But I suppose more recently, and particularly, some of the volatility in markets, if we think back 2 years ago, whenever we had the situation where coronavirus came upon us, nobody could foresee what was happening. The global world was stunned. It had created lockdowns. We had no vaccines. Nobody knew what was going to happen. Equity markets went down quite strongly. And just to show you how the Goodbody Dividend Income 4 did, this is back 2 years ago in the first quarter of 2020. So if you look at the left-hand side of this chart, what you will see is that global equities, that's the market of 1,600 of the largest companies in the world, fell almost 20% in that first quarter. You'll see that we had some equities, they didn't fall as much. That's the yellow line, it went down 9. You'll see that our bonds and our gold and our REITs didn't do very much either. But the key thing that helped investors in this fund is the risk overlay. So we buy an insurance contract that protects us somewhat. So it's a bit like your household insurance. You buy this insurance contract, you hope you never need it. If you don't need it at the end of the year, yes, you've paid your premium for your insurance and it's a little bit of a cost. But if markets get volatile, these insurance contracts go up. So you have a fund, you know, that has a good exposure to dividend paying companies. You had a market down nearly 20%, and the fund, which is the green bar, went down 2.5%. So that's one of the risk overlays that New Ireland have in their stable if you're looking for maybe a multi-asset fund with a risk managed approach. And maybe at this stage, what I'll do is maybe hand back to Stephen again, and maybe he'll talk a little bit about another fund that New Ireland have that also has a risk management approach.
James, just before I explain this one, quick question has come in. Well, we've had 4 or 5 people ask the same question. We hear in the market now the mention of the 3-letter acronym ESG. Would you mind just explaining maybe what ESG is and why it's become important, I suppose, in the investment manager world and for clients, obviously? Absolutely.
Yeah, it's actually become very, very important. So it has to a lot of investors, particularly over the last 12 months or so. So ESG stands for environmental, social, and governance. And what is happening in the market is that a lot of potential investors are looking to their fund managers to incorporate these standards into their funds. So the environmental is actually relatively straightforward. So what they're looking for there is that investment managers go and they're talking to the companies that they're investing in, and they want them to check to see, look, you know, how much emissions are you putting out? How much CO2 are you using? How much packaging are you using? You know, how much are you using in water? So these are the sorts of questions that today that we're asking the companies that we invest in, and we want to know and monitor it, and we want to know how companies can do better on the environmental side. So that's the E side. The S side is the social side. So that's a little bit more about the engagement that the company has generally with its environment. You know, what's it doing to help its employees? How is it engaging with its suppliers? How is it looking at other metrics like, you know, it's maybe perhaps things like its gender balance, its promotion of different types of people in different areas. That's the social side. And then the governance part is another very important part, but it's to do with, you know, how companies are structured. You know, what's the audit committee like? Are they paying their directors too much? You know, is there a good remuneration committee there? What's the risk systems like? So that's the whole governance side. And once again, that's something that we engage with all the companies that we invest in. We're asking these hard questions from companies. And I have to put my hands up. There's some companies out there today that don't have a lot of information on that. But there's no doubt that the regulations are going to be coming in from Europe. And over the next 18 months, we're going to see a massive switch. And this ESG is going to become really the topic of the day and something we're very much focused on.
Excellent. Okay, thanks for that. It's very good. Yeah, so I just want to touch on one other fund here today, and this is a fund with an explicit capital guarantee of 85% of the highest fund value of your particular fund. So again, it's made up of a diversified basket of assets like cash, like property, bonds, equities, as we discussed before. But there's a capital protection built in for clients that might feel that they'd like to have some sort of capital protection there, that if markets did get particularly volatile or markets did fall, that they couldn't fall below a certain point. So this fund works on the basis that the capital protection will kick in, but it'll actually increase, and I'll touch on how this works, but it actually will increase if the fund value goes up, your capital protection goes up in line with it. It's a fund that you can get in and out of. Sorry, Claire, yeah?
Yeah, so just going back to remember our numbers, like the numbers we had from 1 to 7 when we did the, like, do we, you know, what type of client would this suit, do you think?
Again, when this actually falls under ESMA 3, because it has that capital protection, although it has exposure to all the assets like the other multi-asset funds, it actually falls under the number 3 because it has that 85% capital protection. So again, a fund that's been hugely popular, and we have over 400 million in this particular fund in New Ireland. And when markets do get difficult or do get volatile, people like the comfort of having, an 85% capital guarantee. But again, the beauty of this particular fund is that you can actually use it in conjunction with other funds. So you can have 50% of your money in something like this and 50% of your money in GDI3. So you can have that diversification across two different types of funds, two different types of managers, two different types of styles. So that's the beauty of it. As I said, number 3 there is liquids and it's daily access. So you can actually get in and out of this fund as well. Some of these funds in the market, you'll find that you're locked into them for 5 years or something. This fund, you're not. You can actually get in and out of it. And it has what's called a passive investment style. And then there is that risk management as well around volatility that James talked about. So if markets get volatile, we can actually reduce down the amount of equity risk. So it has that sort of risk management of reducing down the equity risk. And it also has capital protection. Just want to touch on the capital protection. Capital protection, as I said, is 85% of the highest fund value. So if you start off with 100,000 euros, you actually have an 85,000 euro protection in there. If the fund value rises to 110,000, you can see on the right-hand side, 85% of 110, your capital protection is now up to 93.5. If the value then falls from 110 down to 95, you on the right hand side can see that your 93.5 protection is locked in. And then if the fund value goes back up to 120, you then get an increase in the capital protection of 85% of the 120. Your capital protection is now 102% of your original investment. So again, works very well in the market and works well as a diversifier alongside other funds. I just put a few slides together. I'm conscious of time, and I know we've crammed in an awful lot, and this slide looks a little bit busy. Well, all it has 5 lines on it, and you'll see at the bottom, the red line is cash. So you can see across there, that's been cash over the last 2.5 years. And you can see here, I talked earlier on about risk and reward, that the gray line, which is the MSCI World Index, so that's all the equities in the world all put into one big pot. It did 41.8% over the last 2.5 years. But you can see the line. It's very, very volatile. It's up and down, up and down. You'll see in April 2020, it took a considerable hit there. Now, if you have the capacity or you have that propensity for risk and you're comfortable with it and you stay the journey, you can see that it ends up over 2.5 years outperforming everything else. But it's a little bit of a roller coaster.
You just have to be able to stomach it though, really.
Indeed, yeah. But you can see there the Goodbody Dividend Income 3 Fund, Sentinel, and you can see Dividend Income 4 Fund. They're doing exactly what you would think they would do. The ones that are taking more risk are getting more return. The ones that are taking less risk are getting less return. So some of them smooth out the journey, and some of them, but again, sit down, get advice, and the advisor and the planner can take you through which fund would suit you best after doing the questionnaire.
Good.
So just moving on.
Yeah.
Sorry, James. Yeah.
I think there, Stephen, you're hitting some very good points in terms of, if you can handle the volatility and you can stay invested, then, you can maybe take a little bit more risk. But, you have to be cognizant there'll be certain times you need your money, so you mightn't want to take too much risk. But I think, certainly for most people, and I think you'd agree with me, it's really focusing in on the long term.
Absolutely. If you're going to invest, I know it was mentioned earlier on with the buckets, but if you are going to invest, you have to be leaving your money for a minimum of 5 years in that investment. Do a plan. Make sure that the plan has a time frame built into it, and you stick to that plan. There's no point in sort of halfway through the year, just because markets are down a little bit, sort of go, no, panic and you move, because we know from experience that, and I remember in New Ireland when we had the financial crisis in March of that financial crisis, we had the most amount of people in the country coming out of funds in March, and March was the bottom of the market. March was the time when the market turned, and from then on went up for the next 10 years. But people get out of markets, they find it very, very difficult to get back in. So if you have a plan, take the plan, stick to it. There's an old phrase, as you know, James, in investing, and it's called time in, not timing. So spend the time in there, ride out any blips. If you've got the right attitude to risk after doing the questionnaire, you should be comfortable with that volatility. And over time, the majority, I think you've got some statistics here, but we just show how over time markets do outperform on the long term.
Yeah, Stephen, this is just looking back over the last 20 odd years or so, and looking at the global equity market again. And what you can see, there's about 7 instances where we've had some significant corrections. I suppose on the very left-hand side, we'll all remember the dot-com bubble and what may have happened there. And sort of in the middle there, as you mentioned earlier on, we had the financial crisis and the market hit its low in March 2009. And then on the very right-hand side, there's that little bar there where you saw the 31% decline, and that was all due to COVID. So these drawdowns, they are actually quite normal. They do happen, over periods of time. But what you ultimately see is that markets do go up. And for those people that can actually stay invested, they typically actually do quite well. But the other thing as well is that markets just don't go up in a straight line. And I just want to show this chart. And I know there's a lot of figures on it and there's a lot of bars and dots, but it's really actually quite straightforward. What this line, what the bars here, the green bars show, is the return of the world index each calendar year. So if you go, say, to the very right-hand side there, what you'll see is that green bar was up 31% last year in 2021. So world equities went up 31%. They went up nearly a third last year. If you look at the 2020, you'll see it was up 6%. 2019, up 30%. 2018, down 4%. But what you'll see below the bar is a red dot. And this red dot shows the drawdown. So this shows how much did the market fall during the year. So last year in 2021, while the market overall went up 31%, at certain points during the year, the market was down 5%. Of course, 2020, we had the collapse in markets because of what happened because of COVID and the shutdown. So the market actually, during the year, went down over 34%. But at the end of the year, the overall market was up 6%. But the important thing to note is that the average decline every year in the market over the last 20 years is about 11%. So if you're investing in equity markets, you've got to expect that at some stage during the year, you're likely to see a downturn of 11%. But if you can stomach that 11% over the long term, you typically do very well. And the returns from equity markets over that 20-year period is roughly about 14% per annum. The other thing, as you were just saying earlier, Stephen, was time in the market. And this is figures that actually we got from Bank of America. And it looks at the returns of the S&P 500. So the S&P 500 is the market in the United States. It's the 500 largest companies that are quoted. And this goes all the way back to 1929. So we've nearly got 100 years of evidence here. And what it's showing here is that if you went and you took all your money today and you decided to invest for just one day in those 100 years, you picked out any one day, let's say 24th of April, 1954, the probability of you actually getting a negative return is 46%. That's the probability. So it's nearly 50-50. If you stayed invested over any 5-year period in the market, any 5-year period, the 24th of March, 1954 to the 24th of March, 1959, the probability of you losing money is just 10%. So the probability of you making money is 90%. So what this shows is that the longer you can stay invested, the better the chances are in your favor of getting a very favorable outcome. So maybe with that, Stephen, I'll maybe hand back with you if you maybe just want to wrap up in terms of some of the next steps.
Yeah, look, I hope everybody got something out of tonight. Any questions, obviously go to your financial advisor in Irish Pensions and Finance. And they will take you through, as I said, the process Wendy has talked to you about. Well worth doing, because you need to, as I said, establish that appetite for risk by completing the questionnaire. And then when you have that, we would then be able to build something that actually suits your particular investment needs. Again, reduce your risk by understanding your investment. It's a friend of mine once said, it's not the thing that's the thing, it's the thing behind the thing that's the thing. So very important that you do sit down, and the fact that you've come on here today and listened to this, I hope you've learned something, and it will help you to understand investments and understand putting the right plan in place. But the most important thing is, when you do put that plan in place, is to stick to it. And don't be caught up sometimes in the noise. And an example of that might be, again, we discussed about the Ukraine. there was a huge amount. This is an awful tragedy, and it's an awful thing, and you know, it has affected so many people, and so many you know, prices and costs of things, everything else. But in fact, investments have actually gone up, as James said. You know, markets are up 5% since the invasion. So sometimes the noise in the market can get in the way of people actually sticking to their plan. But on that point, Claire, I'll hand back over to you. And thanks for the folks for your time.
So thanks a million, James and Stephen. We really do appreciate it. So before we wrap up and we do our little competition, we're going to open up the chat function in a minute to see who's going to win the €100 voucher. Just from the client's point of view, Wendy, couple of questions, all right? So I'm sitting here and I'm a client. So I had actually Arthur in the HSE, and Wendy was wondering, like, you know, what was the minimum amount he could invest. So
yeah, so Claire, the minimum, you know, that you could invest would be about 20,000. Okay. Now I suppose, you know, there's a few things that we'll consider. I'll talk to you about that in a slide, 2 slides next. Just about maybe what to be investing. Mm-hmm. But again, I suppose there's a few things that you need to consider before actually taking up the consultation, and for you to be best prepared for the meeting. So I suppose there's a lot of questions that I would say to maybe consider. There's a lot of information that everybody has got tonight, and I hope people found it useful. It certainly got me thinking when I watched it last year. There was different information.
Definitely.
You know, the price of wood had gone up last year, so now we're looking at different things this year. But I suppose the questions that I would ask myself, and again, get the people involved that might be making this decision. So, you know, if you're a couple that you're planning on investing, if you're coming up to retirement and you want to make the most of your money, for your family, again, make sure the two of you are involved in this process. The questions I would ask would be, how much do you have available? So again, we spoke about the 3 pots there earlier, but I suppose, what do you have available after your short-term needs? Okay, so again, think of what you need in the first 5 years, and thereafter then we can strategize and create a plan for you to help you achieve your medium to long-term objectives. The second thing then we have there is, what time frame do you have to invest in these pots? So, you know, James really made it clear there, you know, it's not about putting it in for 1 day. It's not putting it in for 1 month. You need to be invested at least 5 years. The probability of, you know, positive return was outlined in that. You know, you're getting a negative return would be 10% if you invested for 5 years. So, you know, the longer you can stay course, the better. The third would be your primary objective. So everybody's going to be different. Claire, you'd be surprised what people are investing for. I know, like, you know, some could be changing the car in 10 years. Some can be for the children's weddings. Some could be looking after grandchildren or buying a second property. Again, it's different for everyone. So again, I'd be thinking about them, getting the conversation started at home. The third would be, will I need to draw an income from it? So again, another thing that we see people save for might be your children's 3rd level education funding. So again, this might be a pot that you'll build up for, you know, 15, 18 years down the road. Mm-hmm. Do you want to be able to draw an income for that to supplement your child's, you know, funding for education? So again, there's different, you know, needs for each individual. But again, are you going to need an income for it would be a question I'd ask. And then obviously what we tied into earlier, what access will I need, if I will need any? So again, that helps us shape a plan for you.
So these, I suppose, Wendy, they're the questions, you know, before you sit down with IPF, have a think about these. Now I know the next one here we've kind of covered. We did cover this quite well. So I suppose I'm just conscious of time because we've kind of ran over. These are other considerations that, so I could actually, Veronica and Tala, she just asked about charges, Wendy.
Yeah, so there's different charges involved in an investment, right? There's 2 charges. One is an allocation charge, okay? And
what does that mean to somebody who does, you know, allocation?
Yeah, so allocation means the amount of your money that's actually applied to the fund. So for example, if you put, just doing easy maths here, Claire, if you put 100 grand into an investment and you received 100 grand or 100% allocation, the full 100 grand is invested on your behalf. Okay.
Right.
So it's important that you understand the allocation rate that you're receiving. The second thing then is the fund management charge. So this is the charge that is taken annually for the likes of the example today, James, you know, Goodbody, managing your money every year and making decisions on your behalf.
Perfect.
The investment portfolio. So they're the two things there for Veronica.
And obviously, I suppose, like, we'll go through that with, like you said, with the client. If they're making, before they make a decision, they'll be really aware of what the allocation, fund management. I suppose the next question about the extra charge. So say, for instance, the Sentinel fund, Stephen, that would have a little bit of an extra charge, or, you know.
Sorry, I was on mute there, Claire. Yeah. Well, it happens in the market. Like different funds that have more explicit, like guarantees, can cost money, and so depending on the type of fund, whether it's a specialist fund or not, you can have slightly higher management charge. But again, if the fund is doing what it says on the tin, you know, it's more than worth.
The client might feel it's worth paying for that comfort.
Absolutely.
Or what have you. Yeah,
exactly.
Brilliant.
Exactly.
And then Wendy, I suppose the other considerations then are
the additional contributions. Like, you know, some people want to dip their toe in an investment. They might never have done it before, and you know, after seeing today and you know, seeing the impact that they're having on their money, leaving their money on deposit, they might want to test the waters. But I suppose the additional contributions is you might find at your next review you've got more money that you'd like to put aside, and you can top up those investments. Or again, you can look at an alternative. Stephen spoke about the jigsaw. You might want to diversify where you're putting your money. So again, you mentioned, Claire, at the start, we're not tied to any one company. So again, we can look at different places to invest your money. The other one there is encashment. So I suppose, is there a common question that we get is, look, do I get penalized for taking my money out? Again, that depends on what investment vehicle you go into, whether there's exit penalties involved. But as we said, we would be advising that you stay the 5-year period. And normally anything with encashment penalties would normally be about 5 years. But again, that will be outlined to you at the consultation. You know, some people like to have that for more so the discipline of it as well. They're dipping into it. What happens on debt? Well, look, it's passed your estate. The money doesn't die with you. So again, you can put it in your will, or it can just go to the estate. The second last one then is taxation. So yes, we'll discuss that again at the consultation. There is taxation on any gains made in investment in Ireland. And it also has, there's other considerations of how long you're invested as well. So that's something that you'll discuss with your advisor at a consultation. But most importantly, what James said is review the plan. Okay, so, you know, even in times where there might be a downturn or the likes of Ukraine, speak to your advisor. It's about, you know, sticking to the plan, as Stephen said, and making sure that you're on track to get the returns that you were looking for at the outset. Great.
Okay, thanks so much, Wendy. So look, I've just 2 more slides before we get to our competition. So we have an offer of the month. Okay, so in conjunction with our friends in New Ireland, we are, anybody who, you know, does an investment with IPF between now and May 13th, you're going to get an extra 0.2%, 2.5% invested on your behalf. You've obviously got access to New Ireland's extensive range of funds, consultation with IPF, and then you can choose a €150 voucher between either Brown Thomas or Louis Copeland. So I think, Sarah Connolly, that's run until May 13th.
It is indeed, Claire. Yeah, and we initially launched this just for the month of April, but New Ireland, we're very grateful to. They've opened it up to attendees of the webinar tonight just for an extra 2 weeks. So if anyone is interested, you have another 2 weeks to get in touch and we can organise that for you. Yeah.
Great. And as I said, just one more thing. Actually, it's one thing we've developed a site called retirementclaims.ie. Okay, so what is that for? How is that different from people who are retiring? So I suppose if you or your spouse have a pension, a dormant pension from a previous job, and you're getting statements in about it, or indeed if you worked abroad in the past, like a lot of our friends in the health service, this is the place to go, retirementclaims.ie. What we can do is we can, you know, help you see how the benefits are paid in line with your public sector arrangements. can I amalgamate all my benefits? Because nowadays people don't just do 40 years in the public sector. They might have 10 years in private, 10 years self-employed. So it's a bit of a minefield. So this is why we've created retirementclaims.ie, a place where you can go and you can get advice on how to put all your pensions together, how to take your monies out from the arrangements, what paperwork you're going to need. You know, can I take some of the money now? What, you know, what's the tax implications? So for any of you that are here on the call tonight that have previous pensions, as I said, this is the place to go. Or indeed, sometimes, a lot of the time, it's the public sector worker's spouse might have various pensions. So we'd urge you to go on to retirementclaims.ie. Okay, I think we're ready for a competition, Sarah, are we?
We're good to go, Claire. I'm going to open up the chat room here now. Yeah.
So the first person who's the right answer on this is going to get €100 voucher for either Brown Thomas or Louis Copeland, so that they could have, you know.
Okay, so we've answers rolling in there now.
Have we any correct answers?
Oh, I think we have a few. All right.
So it's the fastest finger first, Sarah.
That's it. That's it. The first correct one in that we see.
Yeah.
Okay, great. I think we've got a couple here now. If you want to throw up the answer
They
there.
were
Claire,
paying attention, were they?
They were indeed. Plenty of them were, absolutely, which is great. So yeah, 70% is the answer. So I think Veronica O'Connor, I think, is the winner there. So well done, Veronica. So you have your choice then of a voucher for either Brown Thomas or Louis Copeland. So if you want to get in touch with us, Veronica, and we'll arrange that for you. Yeah, well done, Veronica.
Brilliant. So look, thanks again. Thanks, Wendy. Thanks, Stephen. Thanks, James, for giving the time. Really informative. I suppose, Sarah, next steps are, you know, we'll send out the presentation to all the attendees.
We will indeed. So we'll upload the video, we'll send it around by email tomorrow, and we'll include all our contact information. So if anyone wants to get in touch to look at that risk questionnaire or to arrange a consultation with your advisor, and we'll get back in touch and arrange that.
Great. Thanks very much. Thank you.
Thanks a million.
Have a nice evening.
Bye.
Bye-bye. Bye-bye.